Intangible assets, IA, including intellectual property, are fast becoming the key drivers of economic and business value. Startups and businesses in FinTech, as well as other fields, are increasingly powered by IA, such as technologies, data, know-how, brands, and ideas. The ability to credibly value IA will usher in a new wave of investment opportunities for the forward-looking private and institutional investors, and is definitely a focus under the Singapore IP Strategy 2030. The panel coming right up will explore the key considerations in securing financing based on IA and provide insights on how investors view and value IA when investing. Please welcome Dr. Kuo-Yi Lim, co-founder and managing partner, Monks Hill Venture; Stephen Robertson, Chief Executive Officer and founder, Metis Partners and IP100; Wei-Pin Choo, Chief Legal and Compliance Officer, Razer Inc., and moderator, Suiling Chia, Operating Partner, Wavemaker Partners. Welcome them, please.
Morning, evening, everybody. So as the MC had said, this topic is highly relevant as the global economy is increasingly being driven by tech and innovation, resulting in an increasing shift in enterprise and economic value to intangible assets. Interesting statistic, the Brand Finance's Global Intangible Finance Tracker 2020 states that the value of the world's intangible assets globally now stands at $65 trillion. And that's about half of global enterprise value. So it's a very, very important point. Certainly for all tech startups, fintechs to fishtechs, intangible assets are particularly critical. Value of proprietary data, algorithms, computer software, trademarks, brands, know-how, et cetera, et cetera. So, and capital and funding being pivotal at every stage of the innovation cycle, and given that the value of many tech companies lie not in traditional fixed assets, but in intangibles, is the financing ecosystem here ready to support the intangible asset-driven economy, given that most of our traditional financing institutions are more comfortable with fixed assets? So I'm very fortunate today to be joined by three distinguished panelists and talking about the topic from three different perspectives. One, from an investor perspective, from a corporate perspective, and from the product specialist perspective. So let me first begin by introducing Lim Kuo-Yi, who's co-founder and managing partner at Monks Hill Ventures, a leading early-stage venture capital fund in Southeast Asia. Kuo-Yi is definitely no stranger to technology and the intangible asset-driven economy. He sits on the boards of Ninja Van, Horangi, Sales Whale, and a bunch of other well-known startups in the region. And also very relevant to what we're discussing today, he's also on the board of the IP Office of Singapore, amongst many other boards that he sits on. Next, we have Choo Wei-Pin, who's Chief Legal and Compliance Officer of Razer. Many of you would know Razer as one of the first Southeast Asian tech unicorns, which has successfully gone public. Wei-Pin oversees Razer's global legal activities, including intellectual property, as well as regulatory compliance. He's been a key member of the core management team responsible for Razer's growth initiatives and as well as M&A transactions, and very importantly, their IPO on the Hong Kong Stock Exchange in 2017. Lastly, we have Stephen Robertson joining us from the US. Thanks very much. Stephen is the CEO and founder of Metis Partner, which is a specialist IP firm, which has a multidisciplinary team assisting businesses in unlocking hidden value from their IP assets. He's been acknowledged for almost a decade as one of the world's 300 leading IP strategists by IAM magazine, and he provides IP valuation and monetization advice globally across Asia, the US, and Europe. So let me first kick off with this question. How has intangible asset financing evolved in the last 2 decades? Why don't we start with Stephen?
Thank you, Sue Lin, and that's an interesting question to pose. I think that what we've seen is the old economy merge into the new economy when large listed companies backed by equity investors began to see the value of their intangibles be recognized, but really understood by equity investors, where the value of the intangibles was built into PE multiples and business valuations. As the old economy moved to the modern economy, some of those principles remained. Warren Buffett still talks about investing in companies with strong economic moats, and an economic moat is built up of intangibles and IP. But I think that what's happened is that the domain of the equity investor has moved and shifted, and lenders and growth finance and venture debt providers have now begun to recognize the value of that economic moat. And they've moved, and so the sands of time have shifted. And so the value of these companies is now being exploited and understood by those who are providing not equity, but debt, because they see that the value of the intangibles are driving the business valuation, are creating the competitive advantage, and those assets are scalable and sustainable. And those are the assets that actually need to be understood and potentially be used as collateral for investment, because what we've seen in the modern economy is that these intangibles now have a value, can be traded in the secondary market, and are sold, and bought and sold all the time. And briefly, what we've seen is that mainstream banks, asset-based lenders, are now comfortable doing what they may call stretch lending against a brand, for example, and taking security over a brand. Venture debt funders will look at all of the intangibles in a business and try to understand the value of those and their significance in growing the business. But now what we've seen is private equity and family offices also seeing the opportunity to build lending relationships with small, fast-growing companies, and finding that the intangibles are an asset class that is not well understood, often under securitized, and able to be released for them to take security over, and so create an investment opportunity to lend or invest money securitized against the intangible assets, because they're not really well understood and properly valued. But it's definitely a lot better than it was 20 years ago.
From the perspective of the region, Kuo-Yi, can I move to you? How have you seen it evolve?
I think if we kind of like talk about Southeast Asia, and by the way, thanks for the opportunity to be on this panel to share some of our experiences. If you look at Southeast Asia, clearly Singapore has always been kind of the hub for intellectual property activities, whether it's from a registration perspective, from a transactional perspective, it's always been kind of at the leading edge of IP-centered financing activities. And clearly the last 10 years of vibrancy in terms of the tech ecosystem has really thrown up a lot of companies with very significant growth in valuation. And a large part of the growth in valuation has to be attributed to intangibles, right? I mean, look at the book value of a lot of these startups, they really don't account for the full valuation that they are accomplishing. And so I think there is implicitly quite a bit of acknowledgement and realization that intangibles, whether it is IP, patents or brands, brand positioning, have value. Now, in terms of Singapore, in terms of what the government had tried doing back in 2014 and between 2014 and 2018, the Singapore government and the IP Office of Singapore, IPOS, have actually rolled out a IP financing scheme program that attempted to catalyze an ecosystem around specific, very explicit financing with IP as collateral in conjunction with several banks and industry practitioners as well. I think one of the lessons that was learned from that pilot program over the course of the 4 years was that while there were clearly expectations as well as recognition as value in IP, the ecosystem just wasn't deep enough yet. Deep enough from the perspective of having sufficient professionals and folks who can value IP, as well as even the secondary markets where people can look at an IP if they were to acquire it, to find a way to be able to kind of circulate and transact off a secondary transaction. So I think it was a kind of a mixed bag from a success perspective. There were some attempts. There were 1 or 2 cases, several cases in fact. But I think at a systematic level, it didn't quite happen. But that was 2 years ago now, 2 to 6 years ago now. So I think we're now at a different phase. In fact, the IP office is looking at putting up a master plan for Singapore's IP 2030. So there will be some recognition that, hey, we might be farther along now. The ecosystem is richer now. You have folks like Razer who went public as a comparable in terms of how things can be valued, etc. That can sort of aid the market and move it along for a more mature kind of IP financing system that we might anticipate in the next year or 2.
Right. No, I think that's a very good segue to Wei-Pin. Given you're actually one of the more recognizable, and I wonder whether the maturity of the business plus the name that you have, the track record that you have, gives you a better success with talking to financiers about IP. Would you like to share your experience, please?
Sure, Shuling. I think, obviously this is more relevant to our time as a startup several years ago. Certainly, we are a tech company in the very sense that, intangible assets form a big part of our value, right? And even specifically talking about IP assets, in the early days, I think we did the right thing in making sure that we were investing time and money to protect our IP assets, to identify them first and foremost, and to protect them. I think several years ago, speaking to potential financiers as opposed to experienced VC investors like Kuo-Yi or yourself, trying to peg a value to IP assets, let alone other intangible assets, was not always the easiest conversation to have, right? It was, that was sometimes the crux of the difficult discussion that was being had around valuation. But certainly, I think we did the right thing to make sure that we had a strong IP portfolio, to make sure that we had identified assets that we could talk to with potential investors, and that at least gave us a foundation to build the value around our intangible assets.
Was it built upon, was it the intangible assets that you talk about, was it more about registered IP already that made it easier to value, or it included other things?
So I think on the IP side of things, certainly things like patents and registered trademarks played a big part of it.
Yeah.
But the brand, as you well know, has a lot more to it in terms of intangible assets certainly on your balance sheet and the value that investors place on the company. So it's maybe because I come from the perspective of the lawyer and the company, certainly having documentation in place that protected IP, that formalized and secured our various agreements with various partners, whether they are licensing agreements, whether they are distribution agreements, all that played a part in creating a portfolio of intangible assets that a potential investor could look at and with some clarity and then start to do the analysis and undertake the valuation exercise.
So from a startup perspective, Kuo-Yi, because at Wavemaker we also have startups which are very early stage, similar to you. How would you, as you think through this, and given where you sit with the IP office as well, from your experiences there, how would you advise your startups to start by protecting their assets, going back to what Wei-Pin was talking about, and to to create branding and to create valuation, based on their intangibles. Starting now.
Very much what Wei-Pin said. I wish Wei-Pin would just write a blog or something of what you just said. I think startup companies will really see value in what you had gone through in terms of being very cognizant and conscious and very deliberate about what your IP are, anything from trademark to patents, and have a very rigorous process in making sure that you document it, you have it kept up to date, think through the strategy around whether to register them, how to register them, etc. And the IP Office of Singapore has a lot of resources in place to help companies in Singapore, which are privileged, I think, to be able to tap on those resources to get those going, even from a very young early stage, a 1 or 2 man shop. I think it's one of those things that needs to be sitting close and in the heart of the company. It needs to be part of the DNA to be always thinking about it. Branding gets built from the very beginning of the company, right? In terms of how you express yourself to the external world, to your users, to your customers, and how you manifest that internally as well. It needs to be consistent. So I think that has to start from day one. And I would advise our companies and our founders to really think hard about that. It shouldn't be an afterthought, right? It shouldn't be something that you only think about when investors come knocking on the door and try to figure out what else can you put on the table to kind of show value. It should always be at the heart of the company and the part of the DNA. Particularly for tech companies, which a lot of them are software driven. Clearly, the more deep tech guys will have IPs, a lot more tangible from that perspective. But for a lot of companies in Southeast Asia, which are more consumer facing, which are more sort of software driven, a lot of that is going to be around the branding, the trademarks, to some extent the methods, right? And all of that needs to be thought through. I'm even in extending that to the whole concept of trade secrets as well, right? I mean, sort of, what part of it do you really want to identify and keep close? And by the process of doing that, demonstrate that this is really where the value is going to be and needs to be recognized by investors and the market going forward. So it needs to be done from day one. They should talk to Wei-Pin from his experience. So Wei-Pin, please write a blog. I think the ecosystem will appreciate that.
Actually, let me do some advertising for Stephen then, because actually, Stephen, your firm provides advice to corporates, right? And not just corporates. I understand the whole plethora of people, a whole range of corporates, investors, banks, etc. How would you advise us in the startup in the early, not just startups, but corporates here? How would you go about building your IP valuations?
Thank you. I think I'd like to just echo some of the things that have been said already, but perhaps in my own words. I mean, I've always admired what has been going on in Southeast Asia to help business owners and entrepreneurs get to grips with IP, recognize the value of IP, and create programs to help them learn. I think companies learn from each other. They learn better from each other, and they need to understand the narrative. And that's one of the things that I think has come out for me in the discussion so far, is that entrepreneurs and business owners need to be able to articulate their IP strategy in business terms. Why do I have these IP assets? What do they provide me? Do they protect margins and help us charge a premium in price? Do the patents give us a competitive advantage by locking out competitors? Do the trade secrets and know-how allow us to expand and grow the business and scale up? So I think that a lot of business owners often think about IP valuation as just a number. I've seen many people who think IP valuation is about getting a number and say, here's our IP valuation, trust us. Whereas I think investors are much more sophisticated now and really want to understand the narrative. What are the specific IP assets? How have you protected them? And how do they create this economic moat or a competitive advantage for your business? How do they scale up in line with your business goals and strategic objectives? And will these assets still be able to be protected and grow and be relevant to your business as you grow internationally, raise more capital, expand the business. One of the things that I found was certainly in the valuations that we do now, we're doing much more opinion on the quality of the IP assets and the impact that they have and the competitiveness of the business, because we believe that's what investors want to read about. They don't just want to jump to the end and read the number anymore. And they also want context. They want to know, is the value of the IP, how does that sit with M&A or exit valuations in the sector? How does it sit with other cross-checks such as profit splits and other accounting and commercial calculations that help investors, I guess, figure out a decision or get comfortable with the value of the IP assets. We certainly have seen great success with the IP scoring system that we created that allowed companies to benchmark their IP against others and then increase their score. And what they were able to then do was increasing their IP score, improving the strength of their IP, gave them a narrative that they could then talk to their investors about and could also use and pitch in their pitch for new investment, and also gave them something that they could talk about in the one or two slides that they may have in their investor deck, which is their IP strategy. What is your IP strategy, and what do you hope to achieve with your IP, and how is it relevant in both now and in the future? So I think the narrative in business terms about the significance of the IP and its relevance to the business in terms of the competitive moat is what investors are crying out for, more than just getting the valuation number.
Okay, so I guess that's on the equity side. More, I'd also be interested to see if Wei-Pin, if when you talk to traditional, like the mainstream banks about IP, what is their typical reaction?
Okay, maybe, I mean, Kuo-Yi, you would have a view on this as well, but I think in my past experience, the banks were not really mandated to extend traditional financing on the back of IP assets, or certainly if they were looking at the IP assets, how should I put it? I don't think we got the value that we were hoping for, right? It was difficult for them to attribute the sort of value that a VC investor would have identified. So that
when they look at your IP, right? Would they use a third party valuer like a Metis partner to help evaluate, or they do their own internal evaluation?
I mean, I think, to be honest, in the past, because IP was always part of a firm-wide valuation that we're looking at, as opposed to trying to securitize some IP assets or trying to realize value just from specific IP assets. It was never a standalone exercise in itself, right? I think other examples in the Razer experience where we have maybe identified certain IP assets for sale, for example, that were no longer relevant to the business strategy or the overarching strategy of the business. We have gone to external parties to confirm certain points so that we could support a valuation or a price that we were discussing. Traditional banks, I don't think we've had so much experience with them specifically for IP assets.
Right. I guess, yeah, okay.
If I jump in here, Sterling, I think I agree, Wei-Pin. I think the experience is that banks are hesitant to take on IP as a collateral. Valuation aside, knowing how much value they put on it aside, the ability to then subsequently sell it on to somebody else and have a market for that, right, was one of the challenges. Banks are not designed to hold on to an IP portfolio and try to figure out how to liquidate it if they need to, right? So I think the lack of the secondary market, as I mentioned earlier, was one of the key challenge. And I think this is probably where we need folks who are a lot more creative, like Stephen or other practitioners in the field, both financiers as well as lawyers and patent specialists, IP specialists, to be able to kind of come together and have a more creative way of how to value these things. For example, you might sort of like finance on the back of the IP right now, there may be a conversion path of that collateral into ownership in the company instead, right? For example. So I think there has to be a more creative way to think about both entry as well as exit for the folks who are financing the IP. And I think, the market needs to kind of speak up and participate. But I think we are probably at that point where we're sufficient companies and momentum in the ecosystem that may emerge. But I'm hoping.
Right. I mean, I suppose we're also thinking about it in a traditional sense of like IP being driven by particular tech. But I'm assuming that the intangible asset economy will just continue to grow as we have more and more like proprietary data, for example, right? There has to be a value around that. And Stephen, I mean, feel free to jump in with regards to like how you think, if we can't depend on the mainstream banks to get there so quickly, what are the more creative ways in which we can finance this asset class?
So if we accept that equity investors understand intangibles through business valuations and analyst reports and brokers talking about the value of the IP in their research notes, and we recognize that now in the modern economy, investors and lenders recognize that these old economy companies need intangibles, but they have to evolve. Then there's a recognition clearly in the global pandemic that we find ourselves in that companies with strong intellectual property assets and intangibles have been able to pivot and change and be nimble. And I think the pandemic has helped everyone recognize that business models are changing. Business models will continue to change. And we all recognize that the importance of IP underpinning those business models. As people recognize that they no longer need to work from commercial offices, that people no longer need to shop physically going into a store. Even my mum at age 74 years of age is now buying her grocery shopping online, doing internet banking. She would never have dreamed to do that a year ago, but the pandemic forced her to get to grips with technology and modern business models. And so everyone recognizes that if those modern business models are working, and if demand is being created by consumers and revenues are being generated, then we need to understand what's driving those modern business models, and it is IP and intangibles. And I think everybody is now beginning to recognize that we can understand them, and we have to get to grips with them because they are going to be the evolution of business and commerce for the next 10 years and beyond. In coming to some of the points mentioned about banks, I used to work for a bank, and I understand that, the guys at the front house who want to do the lending, who want to find good companies, fast-growing, IP-rich companies to lend money to, they're often held back by the underwriting teams, the credit guys, who are looking at it saying, well, where is the stock? Where's the plant and machinery? Where are the fixed assets? And these guys need to begin to take cognizance of, and they are, the value of IP and intangibles, but they need the narrative. They need someone to explain to them, and we've been doing that, the value of patents in terms of keeping competitors out and how you can use patents to do so. The importance of registering brands and building the value of a brand as you want to open up into international territories. The importance of protecting manufacturing know-how and trade secrets if a business wants to expand overseas and open manufacturing plants or distribution channels or installers overseas. So they're beginning to recognize that these assets are driving the modern economy. I think the key thing is the collateral point, which the other panelists have mentioned. I think banks in the past have thought we only understand registered rights. We can get security over patents because they're registered and trademarks because they're registered. But now banks and lenders are becoming more comfortable with software because they can see they can get a copy of it in escrow. And so that gives them some comfort regarding software as collateral. They can get a copy of it. I think other assets such as data and analytics and trade secrets, once they understand the measures that are put in place to protect these assets, and that these assets can then be sold to third parties, then they're definitely now getting used to having control over those assets in a situation where they need to protect their security or get cover for their lending.
Okay. Any other comments on that point, Wei-Pin?
No, I think speaking from the Razer perspective, obviously we are very keen on a market which understands and is able to attribute value clearly and quickly to intangible assets. So glad that we're heading in that direction. I think it's inevitable given the nature of businesses today. And certainly, I think as the ecosystem grows around it, and looking at Singapore, for example, I think IPOS is minded to grow the ecosystem around this whole practice, right? Essentially, I think then we'll be in a better position to tap on these sort of assets and realize the true value.
Because I'm curious, because you are publicly listed, how do your equity, your institutional investors, right? I mean, when you talk to them, is there any discussion with regards to the intangible assets of Razer, or
Well, I mean, if you're asking me whether we are valued based on the full, fully valued or undervalued, that's a discussion for another day. But I think certainly it's part of the narrative, right? As you well know, the Razer brand is integral to what we do. And underlying tech in our products is obviously also essential. So it's definitely part of the narrative. I don't think we ever communicate or talk about business and strategy without referencing, IP, without referencing the impact of having a brand that feeds through an entire ecosystem or entire platform, whether it's in FinTech, whether it's in hardware. So it's very much a part of the narrative.
Yeah, because for yourselves, I mean, you've got a database of how many hundreds of millions of customers, right? That is very valuable data.
Yes. Yeah. So I think what we haven't done, for example, as I alluded to earlier, is we've not gone to a bank and said, look, this is an asset that I've identified. Tell me how much it's worth, right? How much can you get for this, right? So we haven't had that sort of discussion because we haven't had. It's a more holistic discussion around the broader strategy and the broader story and the broader value proposition. And certainly it's integral to our investors' view of the company and view of our prospects.
Stephen, I want to go back to asking you about, you've seen, I think we talked a little bit about before about an anecdote that you can share to CEOs or who are listening, how someone you've seen recently pitching successfully their IP. Can you share a quick story?
Yeah, I think that and in fact, just before I do that, if I could just chime back to some of the points just made there, I think that banks are now, banks are there to lend other people's money. They are risk averse. They are becoming more comfortable recognizing that they perhaps need to stretch their requirements and stretch their credit limits. And so we've seen what is called stretch lending, where a bank is prepared to give additional money and lending to a company against IP assets. Often brands are the obvious thing because brands resonate with people. And bankers, even though they may not appear to have much emotion, are emotional like all of us, and they will have an emotional connection with a sports brand, a retail brand, a consumer goods brand. And as a result, that may make it that little bit easier to offer some additional lending against a brand if they can understand they can take security over it and recognize that that brand will still have value in someone else's hands. The challenge that we have with banks is that they will never lend against a fair value or a market value of these assets. They will always be looking at what they consider to be a worst case scenario. They call it an OLV or an FLV value, forced liquidation value, orderly liquidation. They're thinking, if this business gets into financial difficulty and I need to call up my security and I need to sell these assets or force the company to sell these assets or appoint someone to sell these IP assets and intangibles, what will I get for them? And that is always markedly less and lower than the fair value. So that's one big issue that we need to get over with banks and understand, is that they will never lend against fair value in my experience. But what we have seen is that there are other providers now who are emerging. There are pockets of expertise and that are emerging. We've seen lenders in Europe who lend to IP-rich companies short-term working capital, bridging finance secured against IP and intangibles. They will lend money against a future R&D tax credit claim. They will, for an IP-rich company, they will lend money against an innovation grant that a company is going to secure. They will lend money in advance of a contract that a company is going to secure with a large customer if they recognize that IP assets are underpinning those transactions. And that's short-term money. So that's definitely going to help. Those little movements of IP understanding and IP ecosystems that are emerging will definitely help to make lending and understanding the value of IP much more mainstream in the future.
Okay, actually, I'm very conscious of time because we only have about 3 minutes left. And I think it'll be great to get some of the names of these banks so that we can, see if we can get some best practices from there, right, Kuo-Yi, and see if we can get our banks here to start thinking about maybe even thinking like 5% of their portfolio looking into this kind of financing. But so we've got 3 minutes left. Can I ask 1 minute each from you to your last words to about this topic, whatever you'd like to share. Can I get you to go first?
Yeah, I'll go first. I think IP, as I said earlier, needs to be front and center. It needs to be the heart of the company. It needs to be part of the DNA of the company. No startup, particularly in this region, can dismiss it or avoid it. So I think pay attention to it, think hard about it, and be proactive about it.
Okay, very good advice. Wei-Pin?
So thanks. I think I'll echo what Kuo-Yi just said. I'll add that even as a startup, it's and you have all these pressing priorities and pressing spend that you want to prioritize, but it really comes back to benefit the company down the road, right? If you invest early on in protecting your IP, in designing a strategy around IP. So I can't stress that enough for the startups.
Yeah, no, very, 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 very fair. Stephen?
Strangely, my comments are broadly the same. I think every company should have an IP inventory. What is the list of IP that we have that's really important to us? And what is our strategy to both protect, develop, and further invest in IP to underpin our competitive advantage and create this strong competitive moat around the business? It's really about helping business owners and entrepreneurs build a narrative that they can make it easy for investors and lenders to understand the significance of the IP to their business and its future success.
Thanks, everybody. I'd just like to thank the organizers also for putting this panel together. I think, going back to what Kuo-Yi was saying, the Singapore IP office is very, very active and trying to create an ecosystem that will nurture this thinking. And they have started work on the Singapore IP strategy 2030. And with this government, if they put their minds to it, it will work. But we do need everybody in the ecosystem to help and further Singapore's development as a global IP and intangible asset hub. I think hopefully they're certainly very committed to this, and the public-private partnership should hopefully thrive on this and get the banks in and investors in as well. But thanks very much, everybody, and enjoy the rest of the festival.